What do you think Tesla's stock price tag will be after the 3-for-1 split? These days, it is quite hard to have an accurate prediction of the EV company's stock price given its extreme fluctuations. Stay tuned and keep watching to see predictions for Tesla's stock after the split. In recent months, investors have been greatly concerned with Tesla's stock performance in the market. Tesla stock is currently sitting at $891.45, which is a pleasant deviation from the $600 to $700 price range the EV company's stocks had been in recent months. Today, you will see a scary prediction for Tesla's stock price after the 3-for-1 split. A lot of stocks in the market have been experiencing extreme fluctuations as of late, including that of Tesla and other big corporations. Despite the price dip, these companies are continuously thriving and are considering this as an expected change brought about by the numerous unforeseen incidents all over the globe which affected the economy and consequently the stock market. Earlier this year, Tesla announced a proposed 3-for-1 stock split ratio. What is a stock split? According to Forbes, a stock split is when a company's board of directors issues more shares of a stock to its current shareholders without diluting the value of their stakes. A stock split increases the number of shares outstanding and lowers the individual value of each share. A stock split is cosmetic and could mean that smaller investors feel they can afford the stock, but those investors are minuscule compared to major institutions. Stock splits don't change the value of a company. For example, investors in a company with stock trading at $100 that does a 2-for-1 stock split will simply own two stocks worth $50 each. The value of their two new shares is the same as their prior single share. Yet companies that engage in stock splits often outperform the market, according to Reuters citing Bank of America research. This could be due to investors buying shares in a company after a split because of the perception that the stocks are more affordable. Companies whose stocks have risen to high price often turn to stock splits to make the securities more accessible for individual investors. Tesla shares have tumbled this year amid economic pressures like the COVID-19 related shutdown in Shanghai, which slowed production at a Tesla factory, as well as Elon Musk's $44 billion takeover offer of Twitter. This controversial announcement has put pressure on Tesla stock because Musk has tapped his holdings in the EV company to provide financing for the social media purchase. A 14A filing with the SEC clarified Tesla's plans for the 2022 annual stockholders meeting, which is set to happen on August 4th. Along with the several agenda items listed in the 14A filing, Tesla described its intentions to split its common stock by a 3-for-1 ratio, which will triple the number of available shares and split the price by 1/3 on the day the stock split takes place. This move does not affect the valuation of the company, but simply increases the number of common shares available of a publicly traded company, while decreasing the price to make shares more affordable for investors. We want to make sure all employees, no matter when they join, have access to the same advantages. We believe the stock split would help reset the market price of our common stock so that our employees will have more flexibility in managing their equity, all of which in our view may help maximize stockholder value, Tesla said in the said proxy filing with the Securities and Exchange Commission. Unlike other manufacturers, we offer every employee the option of receiving equity. It added, oftentimes stock splits can affect the performance of stock since the stock appears cheaper or easier to buy with fractional shares. While the split may be beneficial for aspiring stockholders, existing Tesla stockholders' financial stake will be the same. The only difference is that they will be holding 3 times more shares if stockholders vote to approve the measure. One of the most important reasons for such a stock split is to positively impact investor psychology. As a share price goes up, it can start to seem unaffordable. A less expensive stock can be perceived as a weaker value even if the market cap for the company is the same. A stock split has the potential to increase share affordability. With what is perceived to be a more accessible stock price, investors who might not have otherwise chosen a particular stock could find it appealing. Such a draw could heighten demand and eventually even elevate the stock price. Barclays, a British multinational universal bank that operates as 2 divisions, Barclays UK and Barclays International, is raising its price target on Tesla amidst numerous issues that affected Tesla's production. Barclays is famous for being a major global financial services provider engaged in retail banking, credit cards, corporate and investment banking, and wealth management, and it is raising its price target on the leading EV company by 14%. This suggests that Q2 production is likely to come at about 256,000, which it did at 250,000 deliveries according to the recent Q2 earnings report. Although Tesla CEO Elon Musk is pushing for 300,000 deliveries, only 250,000 were delivered, which is considered the largest decline in Tesla's history. It may be understandable for others though, since this was partially due to the aforementioned China lockdown, which in turn affected the Shanghai factory and caused supply chain issues, and the company took longer to get up and running. On the other hand, UBS also raised its price target, setting a massive order backlog and a substantial margin momentum. UBS Group AG is a multinational investment bank and financial financial services company providing financial services in over 50 countries. They are still expecting a 50% growth for the year. They are more inclined to take a year look instead of a quarter-to-quarter look with an $1,100 price target. They also expect that Tesla's vertical integration and semiconductor software and the battery will result in superior growth and profitability. And since batteries are the biggest bottleneck for the EV industry, they believe that because Tesla has its battery construction and factories and manufacturing, and believe that the company is uniquely advantaged or uniquely positioned to drive higher margins with its batteries and be able to deliver. UBS is so bullish in their bull case scenario that they think Tesla can have gross margins that could rise from 30% where they are currently sitting without tax credits up to 34.7%, which is quite bullish. UBS has upgraded Tesla to a buy position, saying it now sees more than a 50% upside for the electric vehicle stock. Would you buy Tesla stock during the split? Let us know what you think by leaving a comment in the comment section below. If this year's proposed 3-for-1 stock split pushes through, this marks the company's second stock split in less than 2 years. It can be remembered that on August 11, 2020, Tesla declared a 5-for-1 stock split which took effect on August 31st of the same year. The price per share before the split was $2,213.40 per share, whereas shares traded at $442.68 afterward. During this time, Tesla's stock was trading at around $1,300 a share, but the stock split announcement sent its stock price surging to a record high of $2,000 a share, wherein the split resulted in the price per share being reset at around $460 and a valuation of about $430 billion. A professor of finance at the Hyder College of Business at Creighton University, named Robert Johnson, said, "Investors tend to like splits because it signals that they are invested in a thriving company. If the average investor was attracted to Amazon before the split, then it is probably a good time to invest after the split, as it is more obtainable," Stivers said. However, you should only do so if it is a part of a well-diversified portfolio. Some say that while it might be tempting to want to buy into a pricey stock when it becomes much cheaper to do so, eager investors should make sure that stock aligns with their overall investing goals. However, one shouldn't jump all in just to own Tesla stock, for example, unless it's something that has long been a part of your portfolio objectives. It is no secret that Tesla went through a lot of humps and bumps in the past years due to the worldwide spread of the COVID-19 pandemic, which resulted in supply chain issues that plagued Tesla and other manufacturers. It is undeniable that Tesla is still at the top of the EV market. A lot of investors, even those with years of experience in the financial industry, are convinced that the EV company has a lot of potential, and it is more than capable of succeeding in the future in a way more than people expected. However, it is no secret that there is no such thing as certainty in the stock market, given its volatility. Still, the possibilities are endless. It is worth noting, though, that to minimize risks, it is important to conduct a thorough study of the stocks before making a major decision. For more Tesla stock content, visit our channel and watch our other videos.